early stage investing is a people business.
Once a deal gets hot,
99% opportunity.
because the FOMO is so massive.
Very high valued exits.
You got it faster and you got it in a better terms.
Another 30 million in venture capital.
Very wild manner to burn money.
This needs to happen 2-3 times.
Thesis and opportunity.
Find me a founder who is...
Christophe Aumaître, welcome to whatsinstore.show. Thanks for coming.
Thank you very much for the invitation.
Awesome. What's the top advice for a startup when raising money?
There are plenty, but in general, I would summarize it with being prepared. So you have to make up your plan before fundraising on exactly what you want, what you need, and then also especially prepare all the documents, financials, data room. So don't rush into fundraising. Take your time, prepare initial coffee chats with investors, try to get warm intros, make up your mind of whom you want to talk to, prepare your material. It sounds very basic, but I think it's a prerequisite of good conversations.
I think maybe that some people just get disappointed because maybe it's difficult for them even to get to a small informal coffee with some investors. Like we in general get so many requests that it's like I think it's difficult sometimes to get there for some startups. I guess it depends on the stage, obviously, as well. But
yeah, but I mean, it's one of the also core capabilities of a founder being able to get access to investors. Yeah, and I would say that in general the community is very open and everybody is basically very much approachable. And I think it's also important to talk to somebody in the venture firm. It doesn't need to be a partner. I mean, if you have a good investment manager, associate, analyst, everybody is looking to find great founders and great companies. So it shouldn't be too much of a problem to talk to a venture firm if you have a interesting company.
I remember I have an anecdote about this with a friend of mine who's a founder of a company, and he had one of the largest clients that now they have. He needed to go to the C-level, let's say, and there was no way to get there through the channels that he knew. So he started to stalk the guy, everything legal, and then he knew he was going to be at the dinner one day in December, so it was cold, and he was waiting in the outside of the restaurant for 3 hours until the guy was out. And when the guy was out, he tackled him like, oops, what a coincidence. I got completely wild. I have to pitch you this very briefly. And actually, he managed to get the contract at the end. So, yeah, true.
Yeah.
Good.
We also have one company where the CEO was then basically called by one of the founders because they found the phone number somewhere in the internet. And it was a large corporate, and they couldn't get through the whole process. And then one of the founders called the CEO and tried to land the deal by himself. It worked. I think there are situations where this is not appropriate, but you need to be creative.
Yeah. Definitely in Telefonica, they've tried several times with straight the president of the company. Like, poof, okay. I mean, good try. I admire from the outside, but. So now let's go to your history, and why I ask you this is because you're a partner at WENVEST. So I want the people to understand a little bit more who are you and where you come from and what's your journey until you become partner at WENVEST in Munich. So could you tell us a little bit of your story?
Yeah, I would say every story is a bit different, and I didn't take a path which was basically with a predominant end goal. So I started in corporate finance advisory, even though I didn't have a clue about M&A and private equity and advising firms. I just started there because I found it very interesting from the job description and the people I met. And had very exciting years at Deloitte in the corporate finance team. I think in general, we we can talk about it later as well. I think it's very important that you have internal mentors and sponsors who are interested in supporting you and developing you, and then you can learn a lot, and then I think you have a great time, and that's much more important than working for a brand, in my opinion. So that's maybe one general advice or topic. Next stop was then Pro7 in Munich.
You skip when you were at the Burj Khalifa in Dubai. I don't know. I saw that was earlier, I think, in your career. But I saw it as like, what? Why? And how come?
Yeah, that's still an interesting topic. I mean, nowadays people don't look too much in the history of my CV anymore. But
I did.
You did your due diligence. Yeah, that was also a deliberate move, to be honest. When I was studying still at a bachelor degree, I did an internship at Ernst & Young in Frankfurt, and then there was a big discussion of where to go in your basically semester abroad. And then they asked me whether I would want to join Ernst & Young in the US for a couple of months for an internship. But then a friend of mine told me, yeah, why don't you go to Dubai? Now everybody says Dubai is the next place to be. And I never thought about it. And I approached a big hotel chain, Jumeirah Group. I knew that there's a CFO in the hotel. He's German speaking. I approached him, and then there was silence for a couple of months. And then one day I got an email for an interview, basically, and everything fall into places. And then a couple of months later, I flew to Dubai for 6 months in 2007.
It was the winter or the summer?
I arrived first week of January.
Okay.
It was still spring, but I stayed until June. And it was super interesting. I had a couple of different stops within the hotel group. Most of the time I spent in the Burj Al Arab, the big hotel which looks like a sail. And that was impressive to basically walk into the lobby every day of such a place at very young age, and being an intern. I had a great time. You spent the weekend at the beach. And could have been worse.
Gets
to be honest.
done, has vitamin D. Perfect.
No, but that was super interesting, and even though, especially because still in 2007, Dubai was in the development phase, and it was exciting times, and especially I thought it's definitely a more, let's say, interesting line in your CV compared to an audit firm in the US, which is still an exciting place to be, I would say, but something a bit out of the ordinary.
Totally.
That was, I would say, a long time was this the first question when I got into interviews. What did you do there? Why did you go to Dubai?
So
I didn't expect that today, but
you need to refresh sometime. But I stopped you when you were actually starting to the real deal with Pro7.
Yeah, this was 2012. I got approached by a headhunter, and also the first immediate thought was, what should I do at Pro7? I wouldn't consider myself a TV media guy, and basically was unaware that Pro7 is so much looking into expanding their M&A team. So I joined their mergers and acquisitions team in the corporate office, and was then, I think one of my first projects was selling TV and radio stations for the group in Eastern Europe. This was the time when KKR and Permira decided to sell basically all international businesses in Benelux, Scandinavia, and then also Eastern Europe. And again, there was a lot to learn, and I had responsibilities basically from day one. That was very exciting. And then I basically followed the whole Pro7 strategy. I still consider this that this was the, let's say, most exciting times of ProSieben over the last 20 years.
Nice.
Then we started investing into the whole digital space, everything which became Nucom Group in the end. A lot of very well-known players we have basically acquired. We acquired a lot in the travel sector and also price comparison sites, dating. A lot of very consumer-centric and media-relevant businesses where ProSieben could add a lot of value. So I stayed there for a couple of years. We acquired a couple of companies, had the pleasure of working on a very interesting deals. That was exciting.
And the thing is, that will give you then a very good idea about what a fair valuation is and what a potential exit of a company later would be, I guess. Because now I can imagine that if you look at a deal and exit paths and they say, I will sell this company to Vivendi Group for 200 million, you'll be like, no. I could have been in Vivendi Group and I'll tell you this is not going to happen.
Yeah, that's very relevant for what we do now in the early stage investing, that I have worked on a lot of M&A transactions, buying and selling large companies, that it's much more difficult than raising a couple of millions in venture capital. And there needs a lot of pieces need to fall together in order to make an M&A transaction actually work. That's definitely a big asset. But also coming back to your first question, I would say all stations in my career basically build upon each other to a, let's say now, in a very complete profile. But back then I never thought that I will end up where I'm today.
Yeah.
So there's also a lot of, let's say, luck and coincidence in between. So also coming back to the question, what is maybe some sort of advice? I think don't think about it too much. If you are in a place where you can develop and learn and you have a lot of fun, then it's the right place to be, and you don't know what's tomorrow.
Yeah.
And then basically during my time at ProSieben, I started to also being more interested in operational businesses, because I thought doing deals is interesting, selling companies, buying companies, but I also want to look a bit behind the curtain, what it's like to work basically with the people of the companies. So I was in the finance team of an online gaming company in Berlin for a couple of months for ProSieben. And then my last basically assignment was then to take over the merger process of Jochen Schweizer and Maides here in Munich, which we acquired from ProSieben. And then we did a small add-on with Regiondo, and then there was a whole basically transformative process taking place, and then also taking over a lot of HR and people responsibility as managing director for the Jochen Schweizer brand within the ProSieben group. And then I stayed there for, I think, 2 or 3 years, but also realized then where my strengths are and where my strengths are not.
That's important. Super important.
Nevertheless, I learned a lot of being very operational, but I realized that also the investment side is more the area I want to basically work in the future. So I left in 2019.
And that's when you started in WENVEST?
First of all, I left in 2019 because I thought it's not the place anymore for me. In hindsight, it was perfect timing, because 2020, when COVID started, this business was heavily impacted by the pandemic. And then I got to know my partner now at WENVEST Capital, Bernd, who was or is another friend of mine whom I worked together with at ProSieben. I shared an office with him, and then he introduced me to Bernd, and then basically things fall into place again. Bernd wanted to set up WENVEST Capital as basically his venture firm, evolving out of his business angel activities. As you know, WENVEST is part of basically his family office, or a sister company of his family office. So I developed WENVEST together with him since 2020.
Nice. That's super nice. Like the idea of even creating it from scratch is not like the same when you join something that is already, you build a thesis, you build a team, you build.
Yeah, that was the reason why I wanted to do it.
Super interesting. I think maybe it's fair, before we dive in a little bit more in WENVEST, that of course we will do, is let's see so whoever is listening, especially if it's a startup, but probably it will also work for analysts and associates, but actually even for everyone, like this path of a company where at the beginning, and correct me if I'm wrong. So I'm going to try to phrase or to picture the history of valuation of a company, of a good company that end up being acquired by another one. So at the beginning, you cannot measure yourself on revenues or anything because you don't have anything. So you normally measure yourself on equity, right? It's like, how much do I need
Dilution.
to get diluted? That's it. So I will get diluted 15%, 20%. And it depends how much the market is willing to pay, how good you are as a seller, etc. You move a little bit, and now there's a difficult time. That is when you start getting revenues. Then if they start applying multiples of revenue to you, that's complicated. Sometimes it's better to stay pre-revenue.
Yeah.
But there's a complicated time right there that it would be seed, let's say. So before we have pre-seed, let's say seed is already there a bit complicated. Let's assume you start to get some revenues. Now, you start a mix between dilution and multiples of ARR, normally. Okay. We're assuming many things. I know we're assuming many things. We're assuming a B2B company, for example, obviously, like the most typical one. And then you get to a point where you pass the 500K, 1 million, more or less. Now you start to be in subject of multiples. The next, 15x, 20x, it depends on, again, how good you are. But then we keep growing, and now it becomes more a financial game. Before it was a lot of our expectations. Still it is, even in the stock market.
No, you're right.
But there is a moment, the same way that there is this switch in valuation to from dilution to multiples of ARR, there's a moment, depending on the company again, but that you stop the multiples of ARR and you start looking at the money in the bank. So either cash flow or EBITDA. From your perspective, like what would be the key when thinking of an exit of a company that you're investing in the earliest stages? How should you think to like, wait, they got diluted, they will get diluted now 15%, but now the multiple is 10x ARR and they're growing. And now how much do they need to grow on EBITDA to be able to be sold for? 600 million, so I do a 10x. Like, can you like tell us how you do that process in your mind, even if it's rough, like, but I want to understand a bit more your perspective on this thought of when am I going to be exit and what multiples will I look at?
At least how we look at it, or I personally look at it, most of the companies do not exit at 600 million.
Yeah. Good point just to start with, by the way. Yes. So because sometimes we do expectations.
Just to keep expectations where they are. I mean, we have nothing against a 600 million or a 1 billion exit. But if you succeed to sell a company, that's already a big achievement. But most of the exits, in my view, happen between 30 and 100 million.
That's already a super good insight.
So you already know that if an investor invests and wants to make 2 to 5 times his money, then you know that you are not in a position to pay a crazy valuation in the early days, unless you think it's going to be a unicorn.
Yeah.
And well, I mean, certainly that's the business model of most of the venture capital firms, is to build unicorns, and it happens. I mean, successfully. And that's why they have to make a lot of investments in order to basically hit one unicorn to pay for the rest. For, let's say, most of the venture capital firms. That's basically the business model.
Yeah.
I think we look at it a bit differently because we still want to have a great outcome or a good outcome if we sell a company for 50 to 100 million. There's also cases where we achieve this, and there are cases where we didn't achieve this. That's normal. So for me personally, certainly there is always this phase, as you rightly described, but this will happen every time. Also in the exit, then you have maybe a company which is growing nicely, and you have maybe a small EBITDA. Then also the investor or the private equity firm or the strategic player is trying to make sense of an EBITDA multiple, but maybe they say, it's basically zero. So there is no multiple. Then you have to look at a lot of things to come up to a, let's say, valuation.
Yeah.
So sometimes, especially in the early days, it's more art than science. It needs to make sense somehow for everybody involved, even though the multiple might be crazy in terms of just in terms of numbers. I think there is no plain vanilla answer to your overall question, because it's also different for different companies, also depending on whether the money you invest now, is this the last financing round to be able to build a company with 6, 7, 8, 9, 10 million ARR and then sell? Or is this a business model where you definitely need another 20 or another 30 million in venture capital? Then it's also different.
I get that you like more the first case then.
I think the first case is more, let's say, what we like at WENVEST Capital. We are a private investment firm. We have a single LP. So we invest private money. We know that we might have some insolvencies in the portfolio and that basically companies go bust. But in the end, we want to basically all our portfolio companies to survive and be at least able to come up to a, let's say, more or less break-even business plan, or being able to be sold to a private equity firm or to a strategic player. And still the outcome is sometimes very good and sometimes okayish. But also in terms of our shareholding, certainly if there's a lot of capital required in the future, then we also play less and less of an important role. And then we get diluted a lot. I mean, this is also, we also have cases in the portfolio where we raised a lot of money. Also fine. But in general, I would say, as you rightly said, it's not our basically home turf.
Got it. And then maybe I'm wrong, but I want your take on this too. There are companies that they get to 1-2 million, even let's put it 1 to 5 million, more or less, recurrent revenue, and they stop because whatever reason the market tops, whatever, they don't know where to go, they top there.
Happens, yeah.
What do you recommend first from the startup side, because you also could tell from there, and then from the investor side? So what the startup should do if they're stuck there and you have like, you give away 30-40% of your cap table, it's in others' hands. What do you do as a startup? And then as an investor, what do you do when the company is there stuck for 3-4 years?
I think the good setup we have is that we can be patient. I mean, we don't have a fund life cycle, so we need to basically close down a fund or sell. And we know that sometimes it takes longer than expected. I mean, usually it takes longer than expected, most of the time. I think being in control of your cost base is very important. So if you see that maybe demand is slowing down, so revenue growth is slowing down, being able to set up the company in a way that you are able to grow but do not burn any more money, then if you apply time to the function, then you still can come up with a great outcome. If you just have time to grow then steadily, maybe at a lower pace, but if you don't have to raise additional money to do that, then still in the end you can sell the company hopefully to a strategic player or to a private equity firm, being merged with another portfolio company or so, and then still have a great outcome. Or find also alternative financing ways. Yeah? I mean, nowadays it's not only about basically equity from venture capital firms. We see a lot of revenue-based growth or revenue-based financing, venture debt.
Huge amounts, by the way.
Absolutely.
That, yeah.
And there are there are very relevant situations where it's appropriate to do so.
Do you take an active role? So in these cases, this company that I'm describing, do you take an active role saying, I'm part of the board and I'm going to try to push you a little bit? It could be good, by the way, sometimes also to the founder and to the rest of the people to like do something with this. I know you're patient, you said it, but do you tend to take also an active role on it or not really?
Your patience and active can be...
They can go together.
They can go together,
Okay.
certainly. I mean, we are super active when we are invested, especially for the first, let's say, usually 3 years. We are most of the time part of the board or an observer. Sometimes we then also go back one step, and then being a board member, we go back to an observer seat, and then maybe also just being in the background.
Okay.
But I think we are always involved. And being involved and increasing pressure or asking questions or trying to come up with constructive ideas for a problem doesn't mean that we are impatient. I think patience is just that we are happy to be invested also for longer than usual, just in order to make a good result for everybody.
We jumped too much maybe in the details of specific stuff, and we didn't describe yet the thesis of WENVEST, assets under management, typical size, ticket size, round, etc. Could you?
Yeah, you hopefully our website is self-explaining,
Okay.
but nevertheless, I mean, we focus on B2B software investments. We typically invest 500K to 1 million. If we invest a bit earlier than seed, then we also can do a smaller ticket from time to time. But sweet spot is, let's say, 500K to 1 million. We always reserve capital for follow-on rounds. So being able to at least do our pro rata for the next 2 rounds, that's at least our philosophy. I mean, certainly, as said, if the rounds get too big, then your pro rata share is also increasing, and then we might not be able to fulfill that. But we at least want to be equipped in a way that we can support the founders and company for a couple of years. And this means that we also have follow-on reserves basically parked. We are a small team, 2 partners. Bernd, who is the LP, is also part of the investment committee and team. Then we have 1 investment manager, and usually we have 1 intern in the team. So quite lean. I think we're very fast and hands-on, very entrepreneurial mindset. As you rightly said, we basically developed WENVEST Capital over the years, and we try to be not only investors, but also partners for the founding teams, and be deeply involved in everything.
Do you aim to a specific stake on the company at the beginning if you lead, or?
I mean, we do not have, let's say, super hard equity requirements because we are a bit of a special setup. But certainly, I mean, every investor is looking for ownership for his stake. Yeah? But it depends from time to time. It's different.
Okay, you're not refusing a deal if you cannot get more than 5% or 10%.
We have everything in between both. Yeah.
Got it.
Between 5 and 12, everything is.
Yeah.
Let's say, depending on the size, depending on the round size, depending on our ticket size. It depends.
But less than 5 would be already too little for you.
I think we also have a company where we have less than 5. But
okay. And having this structure that you mentioned that is true, is super lean. How many portfolio companies do you have right now?
Around 24.
Around 24. How do you split your day-to-day between the portfolio, the scouting? It's like scouting could be already that you got companies filtered, but still you need to look at them. You need to understand the market. You need to understand the team. So portfolio, scouting, and let's call it admin to everything that is not portfolio or analysis, investment analysis.
I would say a typical week, I spend 60% on portfolio, I would say, a week. And then maybe, hopefully, only 5% on admin and the rest on new opportunities and networking and getting to know investors, founders.
That's good.
Every week is different, which is great. But I mean, what I personally love is working with the founders on their journey.
Yeah.
So
Yeah.
to be honest,
it's addictive.
It's addictive. I know. You feel very much emotionally attached to your companies and to the founders, and that's great. But I wanted to say, basically, coming from more the M&A background, working on larger transactions, I mean, the technical execution of an investment is very standard. It's plain vanilla. So this is not exciting to me, to be basically to just complete the transaction investing in an equity financing round. So that's what really makes up my week, is basically being involved with our founders and working with them.
Nice. And what would be, if you have to choose one, what would be the main source of your good deal flow?
Business angels and other investors.
Business angels are very good signaling normally. Like, do you categorize them by topic? Like, I remember that, for example, I know 3 business angels that if they send me anything related to fintech, I know I got to take a look at it. Because if they invested in it, they're really wise in that topic. Is that the case? Is it by category, or it doesn't really matter?
Both, but I think the whole early stage investing theme is a lot about personal relationships. I mean, also getting into a startup, you have to have a good relation to the founder, which sounds very stupid, or very basic, but it's true. And the same goes along with other co-investors or business angels. So especially to those whom I like, or the other way around, hopefully they like me and like us. With those, we have the more, let's say, honest and direct exchange of deal flow. And there's also early stage venture capital firms. We have a lot of exchange on deal flow. We're very transparent on which cases we look at. We love co-investing. And so that's part of the game. To be very open and share deal flow.
Now that you mentioned this, there's this trend, VC, how is it called? Data-driven VC. So it's like, many tools, many ways to share the information. Do you envision a future where we all will know all the deals if we want, but still the collaboration will keep going? Or how do you envision this VC data-driven VC in the next future, like 12 months, 24 months?
Yeah, I just said, I mean, early stage investing is a people business.
Yeah.
Which I think you will not be able to replace by tools. Certainly tools will help, especially in your admin work. And I mean, we are a small team. Tools help us to basically be as much as efficient as possible. And we have tools to get to new leads and to interesting companies, to meet hopefully interesting founders, and to basically fill up the funnel. We use tools. That's great. But once you have a contact to a founder and a topic you found interesting, I think a tool will not help you to land the deal and to make the decision
true.
To do the investment. As said, it's a people business. But I mean, tools is definitely a big part of being as efficient as we need to be.
But
absolutely.
Do you envision this like collaboration up until the point that all the deals are just there?
Yeah, sure.
Yeah,
why not? I mean, we also use, for example, Spectre to get to new leads, and I could very much imagine that let's say 80% of the potential investments or companies who are currently raising is very transparent. And there's a lot of also, let's say, it's also part of early stage investing that a lot of founders basically are trying to raise a bit under the radar, and but they then talk to people whom they like and where the personal relationships are. But in I don't know how many years, I think the transparency will increase in terms of who is currently raising, who is talking to whom. But still, then you need to match the one deal which is the best fit
Yeah.
to your investment thesis,
Yeah,
to
true.
you personally, and to the topic you like. And then you still need to basically have a personal relationship to the one who's making the final call,
Yeah.
which is the founder.
Yeah, of course.
So if you have a personal relationship to the founder, then it doesn't matter if maybe 100 other investors have seen the deal, but maybe they don't like it, they don't like the topic, they don't like the founder, they don't like the industry. That's then your job to basically find the topic and the founder which fits to you.
I tend to think that the problem with VC sometimes is the FOMO is so massive that once a deal gets hot, gets hot for everyone at the same time. And the less people that know about the deal, the better, because then you have less competitors, less
Competition, maybe.
less competition in that deal. So it's easier to close. You got it faster and you got it in a better terms than if you have more people bidding for the same deal. But yeah, we'll see, because what you said is actually really relevant, because at the end, in an ideal world, you don't pick the deals that don't suit you, and you're giving more value to the deals that suit you for X, Y, Z reasons. So that's the deals that should. But in the pre-seed, I will have probably Eva from Morpheus. She will come probably to the show to explain how to. Eva from Morpheus. Like it's a startup to do sourcing from deals. So basically, they specialize in pre-seed and seed from that region. This is not a paid sponsorship, by the way, but they are very good recovering all the startups, all the new startups coming up. So it's what you said. Like there are more tools every day that will gather everything outside and will specify it. But the thing is, so for example, to put the example in Telefonica and Wayra. Yes, we look for an angle that makes sense with Telefonica, right? So yes, of course, if we can resell something, B2B, B2C, B2G, or we can use something, of course, it makes more sense for us to be there. But even so, sometimes the deal, it just makes sense because maybe it's a breakthrough. So Telefonica doesn't see it yet, but if we see it, I think sometimes we need to push it to be there. And then the company, if they realize later, we already be in the deal. So for that, sometimes we break the thesis. So the question that I want to ask you is, in WENVEST, what's the like, let's say, the balance between thesis and opportunity? So yeah, how do you?
I would say 99% opportunity. Yeah, I discussed this a lot with Bernd, or also with myself. Who am I to tell basically what the best investment thesis is? I mean, because ideally I want to invest in a founder who's convincing us that this market and this thesis is right. And then we can share the belief, or we don't, but not the other way around, I think. I mean, we are such a small team. We are 100% opportunity driven. If there's something which we like and is interesting, we look at it, and not the other way around.
Yeah. It's insane how it's just about the quality normally of the CEO to sell that in the early stage is just everything. Like it doesn't matter everything, even not even the market, because you could be talking about a market that is about to develop. So what is the TAM? 9 million. It doesn't matter. It will grow. It's even market dynamic. So you can.
Yeah, most of the time it also shows how the founder is also being able to sell his own idea, his own product to a client. And this needs to be convincing. Not if we have basically made up our mind beforehand that this thesis is the right one. This doesn't prove anything. In the end, the market will decide what is being successful and what's not.
Is there any playbook that you have in mind for B2B SaaS companies that you say that there's this famous times 3, times 3, times 2 or something like that? So it's like, okay, once you get to X amount of ARR, I want to see times X, times X, times X in growth year over year, or you're underperforming in X amount of years. Do you have this playbook or not?
No, I mean, we certainly benchmark companies. We look at benchmarks for our own companies, but also when we invest in new companies, we look at benchmarks and KPIs. But in the end, it also comes down to the impact on, for example, valuation. Sometimes a less growing company, if you can get in cheaper, have a higher stake, and then still exit the company on a 3 or 4 times multiple, maybe at not as such a high valuation, but you're still being able to make a 3 times or 5 times multiple on your investment, then that's a good investment.
Yeah.
So it's just, I mean, certainly there are areas where you think, maybe not so interesting if growth is too slow or customer acquisition cost is too high, and that you basically cannot believe that in the long term the unit economics will make sense and that there's a basically path to a profitable business. Then you might not be willing to invest. That's right, but especially with regards to growth, this has an impact on valuation.
But what is it, the growth too slow? So if you're at 1 million ARR, next year you grow to 2 million ARR, B2B business, SaaS.
It doesn't. I believe it doesn't need to be a bad business.
Good or bad? Okay.
No.
It really depends on the context for you.
It depends on the context. It depends on, maybe there is a good reason why they are only growing by 100% in this year, which is still decent. I mean, but maybe there's a big development with a client which is then expanding in the year after because the product is getting more attractive. I don't know. I mean, there can be multiple of reasons. But
yeah. And maybe this is a difference. I'm not sure. You tell me what you think. But when you said 3x, 5x is obviously a great return, especially if you compare to almost any other type of asset, real estate, stock market, ETFs, raw material, whatever. 3, 5x in, I don't know, 7 to 10 years. It's okay. It's very okay. The thing is, I saw that bigger funds, so in terms of asset under management, they're looking minimum almost at 10x sometimes, no?
Yeah.
But maybe because they have money to lose, money to spend, let's say, money to waste.
No, I think it's they need to look at this return in order to make the whole fund economics work. It depends on the basically stage where they want to invest and what the typical ticket size is. But in order to return a 100 million fund 3 times, you need you can do the math. I mean, there's plenty of examples in the internet on that you really need massive exits in order to be able to return a 100 million fund on 2x, 3x. Because in general, they own maybe 10% of a company, maybe at the exit only 5 or 6 or 7. And then being able to get a fund returner, so 100 million out of a 5% stake. And this needs to happen 2-3 times. Yeah, this is quite a good ratio of very high valued exits. Yeah.
We go to the 600 million that we said at the beginning.
And more.
Yeah. I was thinking that maybe there's an unserved market then of companies that maybe they're very good performers, they know what they do, they know the business, but because probably there's not a 10x company or a unicorn company, they don't get funding enough. And I guess that in their medium small funds, they will have an edge. I don't know if that's how you see it or if you have examples in your portfolio of this type of companies that maybe other or bigger funds is like, no, this is not a fund return and there's no way this company will go public. But you look at it also with your M&A eyes and you're like, this company could be easily sold for 100 million.
I think that's the case for all of our portfolio companies, hopefully. Yeah. I mean, certainly I wish for every our portfolio companies that they are being able to exit the company at 1 billion.
Of course.
I'm very happy for that.
Yeah.
But as said, most of the exits happen at 50 to 70 million. Yeah? And still, I have at least we have the ambition, or I have the ambition that we then create a good return for everybody.
Yeah, that's good. So you made me realize that there is this unserved market for VC. And I have a very recent example. I was looking at the company marketing. even though they say it's not marketing, but it's like an enable of marketing. And when I was discussing with some potential lead that is one of these big funds, they were like, our main fear is that all these exits are capped at 200, 300 million. And we don't want that. And that the other day with this that you're saying now is like, oh, this is this gap in the market that I didn't see before that is there. It's like, true, it could still be a great exit, but I tend to trust that was not a good one. Or I tend to believe that was not good, that I should aim for the IPO all the time. But
yeah, I mean, certainly, I would say most of the founders, or maybe already all founders, not all, but the majority of founders, they certainly have high ambition. And they will not tell you, exit below 100 million, that's my goal. They will always say exit at a high valuation is my goal. It's just that statistically, most of the exits happen not at 500 million upwards. Economically it doesn't make sense to believe that all our companies will exit at that high valuation. But you account for that. I mean, that's why you accept companies to go bust, and then there's the 1% chance that you hit a unicorn. That's built in this business model. Yeah? But what I want to say is that, I mean, also the founders, they do not take this for granted that they exit at a high valuation. It's just that we, with our model, still have the ambition to make a good return also for a medium-sized exit.
And maybe this approach, it actually makes more sense, because I don't know now if
we will see.
But even there's data on it. Like, I don't know if I'm being reliable now, which I don't like, but I think I read that 70% of the funds worldwide, they don't even return the money or something like that, which, again, please quote unquote, I'm not sure, but it was, I remember it was a very high number, and I was like, damn it, this is like worse than, my God, this is a very wild manner to burn money. Damn it. And maybe it's because this super high objective, where if they take your approach, it's like, dude, relax. Let's try to calm down the boat with the valuation and with the expectations, knowing that all the companies get sold there.
Yeah, I think you find examples for all the cases you've just described. I mean, there are super successful funds, and certainly not all the funds are very successful, and there are a lot of funds who barely return the money, or at least not a lot more from what they have thought they will do. Yeah, that's true.
Yeah. Is there anything that I haven't asked you yet that you need to say?
I feel you've covered a lot of topics today.
Even the Dubai topic, that was
even the Dubai topic. Yeah, absolutely. and I've been here last quarter in December, but we had some technical issues.
Yeah. This one is way better, by the way. I think it's
okay. Great.
Like your story and WENVEST is way more comprehensible. I should do twice every time. And is there any question that you want to leave for my next guest, even if it's a founder or a VC, or is there any question that you think I should, if I interview a founder or a particular fund, you should ask this?
Yeah, find me a founder who is maybe being transparent on what he thinks about the venture capital landscape. What does he like at firms? What does he or she do not like with working with venture capital firms? I think it's always great to learn, and you don't get honest feedback all the time. Yeah? So that's not a specific question with regards to WENVEST. I mean, certainly if he has something to share to WENVEST, happy to hear it. But in general, what do founders think of the investor landscape? That would be interesting to hear.
And I can already tell you that it's super broad because you have founders that are super centered in the product and things like that. And it's like, I just want the money, go the fuck away. I don't need you here. I just need to build. And there are others that is like, dude, consult me do some sparing stuff. But I think it's a question I should implement in the everyday interviews that I do to founders. Yeah, definitely. Awesome. Then, Christophe, it was a pleasure.
Thanks a lot
for being here.
Thank you very much.
Talk to you. Ciao, ciao.
Bye-bye.